Sometimes the market does things that just don't seem to make a lot of sense. Right now, almost everything's down, except for one sector, sugar. It's not just doing okay, it's absolutely flying. So what in the world is going on here? Let's get into it.
Okay, just check this out. This is a snapshot from March 4th. The broad market? Yeah, it's taking a nosedive, deep in the red. But then, you look over at sugar stocks. They're way, way up in the green. It's like they're living in a completely different financial reality. And that, of course, leads to the big question.
Right? What is their secret ingredient? In a market that's this sour for pretty much everyone else, how are they making it so sweet for themselves? Well, it turns out the answer isn't just one thing. It's this incredible mix of global events, the price of fuel, and some major moves by the government. Okay, so let's start with the first piece of this puzzle. And believe it or not, it all begins thousands of miles from any sugarcane field. It starts with the price of oil. You can really think of it like a chain reaction. A conflict flares up in West Asia, and immediately there's a ton of uncertainty about oil supplies. That fear alone is enough to send crude oil prices spiking. And, well, you know what happens next. When it costs more to fill up your tank, everyone starts looking for a cheaper alternative. And that's where our story really gets interesting. And listen, this isn't some tiny little blip on the radar. We're talking about a pretty significant jump, 4 to 6% in global oil prices. That one event, that single spike, is the catalyst. It's the first domino that falls, and the ripple effect travels all the way from the oil fields to, you guessed it, the sugarcane fields. So what is this attractive alternative? It's ethanol. And what is ethanol? It's super simple. It's a biofuel made from sugarcane. You can mix it right in with gasoline, and boom, you've got a cheaper fuel. And when you're a country trying to deal with the high cost of imported oil, that sounds pretty darn good, right? So the next logical question is, who's making all this ethanol? Well, it's the sugar companies themselves. The big players like Renuka Sugars, they're not just in the sugar business anymore. They're massive players in ethanol production. All of a sudden, their bottom line isn't just about the sugar in your coffee, it's about the fuel in your car. Think about what that does for their business model. They now have two huge ways to make money. They can process their sugarcane for food, or they can switch gears and use it to make fuel. That flexibility is massive. It basically turns them into what people call an energy hedge. It means when energy markets get all chaotic and volatile, they're actually in a really safe, even profitable position. But wait, there's more. This isn't just the market doing its thing. Oh no. This whole trend is getting supercharged by the government. They've basically given ethanol the ultimate green light. And you have to see how fast this all went down. We're talking lightning speed. The E20 mandate gets announced in late February. By April 1st, just over a month later, it's not a suggestion, it's mandatory. And then the real kicker. For the coming season, they completely removed the production caps. The floodgates are officially open. You might be wondering, what exactly is E20? It's just petrol that has a 20% ethanol blend. That's it. But by making it the law of the land, the government just snapped its fingers and created this huge, guaranteed demand for ethanol. It's not a maybe, it's a certainty. And the knock-on effects here are massive. First, sugar mills have a market that's literally guaranteed by law. Can't beat that. Second, it makes them absolutely essential partners for the big oil companies. Why? Well, it turns out ethanol is great at boosting the octane rating of fuel up to that required 95 RON level, which is a big deal for fuel quality. So when the government lifted those production caps, you can imagine how the industry felt. The best way to describe it is with one word: jackpot. It means the mills can now go all in, full speed ahead, on making what is now their most profitable product. All right, let's put it all together now. When you step back and look at the whole picture, you see this isn't just one lucky thing happening for sugar companies. It is a genuine perfect storm, with all these different forces coming together at the exact right moment. Just look at how these big factors affect different parts of the market. Let's start with high oil prices. For most companies, that's bad news, right? It means higher costs. But for sugar companies, it makes their ethanol worth more, so positive. Okay, how about geopolitics? For the broad market, that creates fear, a risk-off feeling. But for the sugar sector, it just makes a local energy source like ethanol seem even smarter. And finally, policy. The rest of the market's worried about things like high interest rates. Meanwhile, the sugar industry gets this custom-built, super positive government mandate. It's a complete reversal of fortunes. So when you see it laid out like that, it's clear this isn't just some random accident.
It's this incredibly rare moment where global events, government policy, and what the industry is capable of doing all line up perfectly. And each one of these things makes the others even more powerful, creating this once-in-a-while opportunity.
And all of this leaves us with a really big question to think about. You know, the line between what we grow in a field and what we put in our fuel tank is getting blurrier every single day. So you have to ask, in a world that feels increasingly unstable, is sugar actually the new oil?
Welcome to this deep dive. Normally we're sifting through these massive research reports or really dense academic papers.
Right, mountains of tech.
Exactly. But today we are doing something a bit unusual. For you listening, our entire source material today is just a single image.
Just one screenshot.
Yeah, one screenshot. It's a daily candlestick chart for a stock ticker named Renuka, and that's trading on the NSE, the National Stock Exchange. Our mission today is to decode the hidden story locked inside this one specific visual. Because if you're someone who really wants to understand how traders read the market...
And how they spot institutional footprints.
Right, exactly. This image is the ultimate aha moment just waiting to happen. For those of you tracking market mechanics, a chart is never just a static picture. It's a real-time map of human behavior and shifting sentiment.
That is absolutely the right framework to start with. Because when you look at financial data visualization, especially a daily time frame chart like this one, you aren't just looking at math.
You're looking at people.
You're looking at the net result of millions of micro decisions. I mean, every line, every volume bar, every single indicator reading is the physical manifestation of fear or aggression or conviction.
Okay, let's unpack this. Let's start by looking at the big picture trend, the macro environment this stock has been trapped in. If you look at the x-axis running along the bottom, you can see the timeline.
Right, the dates.
Yeah, it begins way back on October 16th. And as we move left to right, we pass the end of 2025. You see markers for like 29th of October, 10th of November, 12th of December. Then we cross the boundary into 2026, and the data finally ends on the far right edge on March 2nd.
And the duration of that timeline is just critical for contextualizing what happens later. Over those 4.5 months, the chart illustrates this absolutely brutal textbook downtrend.
It's painful to look at, honestly.
It really is.
Yeah.
If you look at the price scale on the right side, Renuka was trading up near highs of around 30.78 back in October. And from that peak, it hasn't just dropped. It has just methodically bled out for months.
Yeah, the structure of that decline isn't a sudden crash. It's this slow, grinding sequence, just lower highs and lower lows.
Which is actually why this matters so much. A chart like this reflects collective psychology. For months, the dominant emotion was just total pessimism.
It's the boiling frog scenario.
Exactly. A low volatility bleed is arguably way more psychologically damaging to retail traders than a sudden crash.
Because a crash bounces, right?
Right. In a rapid crash, you get panic and capitulation, but then you often get a V-shaped recovery because value buyers rush in. But a slow 4-month grind, every minor little bounce gives those trapped buyers a false sense of hope.
Only for sellers to step back in and push it lower.
Exactly. The market is communicating a complete lack of institutional interest. The overhead supply is just suffocating the asset.
Which brings us to the anomaly, the dramatic shift at the very end of the chart. After months of this grinding suppression, everything changes on March 2nd.
It's a complete regime change.
Yeah, the chart prints this massive green candlestick that just structurally shatters the recent downward pattern. Let's break down the actual anatomy of that reversal.
Let's do it.
At the top left of the image, there's a row of numbers for that final day, this alphabet soup. It says O 23.25, L 22.90, H 25.99. And C, 25.25. Can you translate that for us?
Absolutely. So for anyone learning to read price action, those letters are the DNA of the candlestick. O is the open.
Okay, so the day started at 23.25.
Right. Then we have L, which is the low. It dipped slightly from the open down to 22.90. And keep in mind, that is the absolute floor of the entire recent trend.
Wow, so it hit rock bottom first.
It did. But then H is the high. Buyers just rushed in and aggressively pushed the price all the way up to 25.99.
That is a massive swing.
And finally, C is the close. It settled just a bit below the high at 25.25.
So what's the psychology behind those specific numbers?
What's fascinating here is the violent tug of war they represent. Look at the gap between that low of 22.9 and the high of 25.99.
It's huge. Roughly a 13% upward swing in a single session.
Exactly. When you visualize a candlestick, that gap creates a long body with little wicks on the ends. The fact that the price was violently rejected from that 22.90 level suggests that buyers absolutely overwhelmed the sellers.
So all that panic selling at the bottom just got absorbed.
Yes, all of it. Large buyers likely had limit orders sitting right there waiting for retail traders to throw in the towel. And once that selling dried up, the buying pressure faced zero resistance.
But what about that little pullback at the end? It peaked at 25.99 but closed at 25.25. That creates what you'd call an upper wick.
Right, an upper wick, which means sellers were still lurking up there, swatting the price down right before the bell.
So that's the trap buyers we talked about earlier, the ones who bought back in December.
Exactly. They've been underwater for months. The moment the price surges back to their break-even point they sell, they just want out. But the key takeaway is that the buyers were strong enough to absorb that supply and still secure a massive net gain for the day.
Okay, let's move to the technical layers, because the price action isn't happening in a vacuum here. There are these lines draped over the chart.
The channel indicators.
Yeah. There's this red line flowing right down the middle, and it's hugged by two green outer lines. It creates this sort of downward channel.
So while the image doesn't explicitly name the indicator, it's acting as a volatility channel.
Like a boundary for the trend.
Precisely. Notice how throughout that entire months-long downtrend, the price is completely trapped below that middle red line.
I see that. Every time it tries to rally and touch the red line, it just gets rejected. It's like a ceiling.
It acts as dynamic resistance. Often in algorithmic trading, moving averages or center lines like this act as automated trigger points. When a stock is in a downtrend, algorithms are programmed to sell the moment the price touches that line.
It's a self-fulfilling prophecy then.
Exactly. But look at what happens on March 2nd.
Right on that final day, that massive green candle violently pierces right through the middle red line. It just shatters that algorithmic ceiling.
Which signals a potential break in the long-term trend. The algorithms that were shorting that red line are suddenly offsides. They have to buy to cover their positions, which just adds to the upward pressure.
It's a squeeze. But a breakout like this is only real if there's actual capital backing it upright, which naturally brings us to the momentum engine at the bottom of the chart.
Volume, the ultimate truth teller.
Right. So I'm looking at the bottom panels. There's a faint Nuvalma watermark in the background, but I want to focus on the section labeled Volume. The visual contrast here is just staggering.
It really jumps off the screen.
For months, the volume bars are tiny, just these microscopic little blips hovering around this baseline marked 8L.
So 8L stands for 8 lakh in the Indian numbering system. That's 800,000.
So an average of 800,000 shares trading a day.
Which shows total apathy. Nobody big was interested.
But then on the final day, March 2nd, there is this towering green skyscraper of a volume bar. It rockets up toward the line marked 2CR.
2 crore. Or 20 million.
So we went from 800,000 to 20 million shares in one day. That's an explosion of activity, a 25-fold increase.
And if we connect this to the bigger picture, that scale is everything. Price movement without volume is just a rumor. It can be easily reversed.
Like a fake out.
Exactly. But price movement with a massive volume spike like this, that is a loud, aggressive declaration.
So that's institutional money stepping in.
It has to be. Retail traders simply don't generate 20 million shares of volume on a random Tuesday without major news. It takes heavily capitalized conviction to absorb that many shares.
Let's talk about the other panel down there. It says RSI 14.
Ah, the relative strength index.
Yeah, I know it acts as a sort of momentum thermometer. And looking at it during the downtrend, it was incredibly low, just suppressed in the basement.
Because it measures the speed and magnitude of recent price changes. In a sustained bear market, the sellers are dominating, so the RSI stays low, usually well below the 50 midline.
But on March 2nd, it hooks sharply upward. It almost looks vertical. And the current value is stamped right there as 48.50.
Right. It's almost perfectly at the midline of momentum.
So in just one session, the buyers dragged that 14-day average all the way from the basement right up to the neutral line.
It's a massive transfer energy. It effectively neutralized months of deeply entrenched bearish momentum in a matter of hours.
So what does this all mean? How do we synthesize all these different clues for the listener?
We pull the three pieces of evidence together. Number one, you have a dramatic price rejection from the absolute lows, which created that massive green candlestick.
Right.
Number two, the price structurally broke above that middle red trend line, which had been a hard ceiling for months. Number three, all of this was backed by an unprecedented explosion in trading volume, combined with the RSI momentum thermometer spiking upward.
It's a very compelling setup.
Yeah.
But we have to be impartial here.
Yes, we do.
Yeah.
Because charts only show us what is happening right now, not what will happen next.
They map the present.
Exactly. This represents a massive shift in market behavior for Renuka on this specific day. It's a high probability setup for a reversal, but a broader market shock could invalidate the whole thing tomorrow.
So we've taken this single complex financial screenshot and turned it into a clear story. A story of shifting human psychology. From months of slow, grinding despair to a single day of explosive, high-volume optimism.
It's a beautiful example of how markets communicate.
It really is. And to you listening, congratulations. Whether you are prepping to learn day trading or you're just insanely curious about how financial data is visualized, you now know how to read the vital signs of a stock.
You know how to look at price volume and momentum and see the mechanics of supply and demand.
But before we sign off, there is one more thing, a final provocative thought to leave you with.
Right, because a chart is essentially a footprint left behind by buyers and sellers in the sand. We've spent this entire time analyzing the size, the depth, and the weight of this massive new footprint that appeared on March 2nd.
We measured the volume, the price, the momentum.
But technical analysis never tells us who left the footprint.
That's the blind spot.
It is.
Yeah.
Was it an institutional giant making a strategic move? Was it a massive leak of positive news that hasn't hit the public wires yet? The data shows us exactly what happened. But it leaves the ultimate mystery of WHY entirely up to your imagination.
The footprint is there, but the giant is still hiding in the trees.
Yeah.
I love that. Thank you so much for joining us on this deep dive today. Keep questioning the data, and we'll see you next time.